There will only ever be 21 million Bitcoin. That's not just a meme, it's the core truth of the protocol. New Bitcoin is created through mining rewards, and those rewards get cut in half every 4 years until one day there won't be any more Bitcoin to mine. Well, that's what gives Bitcoin its scarcity. It's why people trust it. It's why people save in it. But it also means something else. There's no way to make more of it to cover empty IOUs. There's no bailout mechanism, so if something's being traded that pretends to be Bitcoin but isn't actually Bitcoin, it creates a dangerous illusion of supply. Just like gold certificates in 1971 when promises outnumbered reserves, well, that illusion for Bitcoin may already be here. We're going to shine a light on paper Bitcoin here on The Effect. Hi, I'm Nate Martin, and this is The Bitcoin Effect. Today, we're putting a spotlight on what's really going on in Bitcoin markets, and specifically, where paper Bitcoin is actually coming from. So let's dig in. We're going to break this open one layer at a time. How paper Bitcoin is created, who's issuing it, and why this synthetic supply keeps growing, even while the real supply of Bitcoin stays exactly the same. If this is the kind of clear, no-hype Bitcoin content you're looking for, hit like so more people can better understand Bitcoin. Let's start with the idea of paper Bitcoin itself. At its core, paper Bitcoin is a claim to Bitcoin, not the asset itself. It's a promise, an IOU. Sometimes it's a trust-based promise, like a centralized exchange saying, "We're holding your Bitcoin, you just can't see it." Other times, it's structured, like wrapped Bitcoin on Ethereum, or through more traditional finance tools like Bitcoin ETFs, funds, or custodial products. The key problem comes when these systems allow more claims to exist than real Bitcoin being held. And that's when paper Bitcoin becomes a synthetic distortion of supply. And it doesn't take much to tip the scale. Well, let's say that 1,000 people deposit real Bitcoin into an exchange, but instead of holding it safely, the exchange quietly uses half of it for other purposes, like loans, trades, or side bets. Well, everything looks fine until too many people try to withdraw at the same time. And that's not a theoretical scenario. When FTX collapsed in 2022, many users believed they held actual Bitcoin. But when they tried to withdraw, they discovered it simply wasn't there. It had been sold, lent, or repledged behind the scenes. The Bitcoin existed on a screen, but not on-chain. And this is where the problem begins to affect everyone, because those fake balances don't just sit quietly in a database, they get traded. And traded again, spreading the risk far beyond the first buyer to everyone who's ever held that claim. And when you've got layers of bets stacked on top of each other, it has an influence on price action and market signals. And all of it happens without affecting real Bitcoin scarcity at all. So the markets trade like there are 50 or 60 or maybe even 100 million Bitcoin in existence. But there aren't. There never will be. Now, I need to go into a digression here for a moment because this isn't really paper Bitcoin, but it is something that still messes with the market. Cash-settled Bitcoin futures. Cash-settled futures are financial contracts that track the price of Bitcoin, but instead of exchanging actual Bitcoin on the settlement date, the difference in price is paid out in dollars. Now, let me explain the difference with agricultural commodities. See, with those, futures exist to help farmers hedge their production. They'll agree to deliver wheat or cattle on a specific date while taking the cash up front. Well, that's the contract. And Bitcoin miners might do something similar. Sell a contract ahead of time for the cash, then deliver real Bitcoin they haven't mined yet. That's still grounded at least in physical settlement. But many institutions trading these cash-settled contracts have no intention of ever holding real Bitcoin. They're just speculating on price. And the deeper that market gets, the more it distorts real price discovery. Because now you have trading activity, but with no connection to actual supply. But let's get back to the real counterfeit problem, the one we saw play out at FTX. That collapse proved how quickly supposed Bitcoin balances can vanish when the coins behind them have been sold, lent, or pledged elsewhere. And the truth is, we don't know if that kind of re-hypothecation is still happening in other corners of the market, because nobody's really regulating it. Not in Bitcoin and not in other digital assets. And it's telling that even the recent White House work group on crypto policy barely touched the issue at all. And honestly, this paper counterfeit Bitcoin might be even worse than other digital assets. Because at least with an altcoin, you know it's not Bitcoin. You're making that decision with your eyes open. But these paper instruments, they pretend to be Bitcoin. They're sold as Bitcoin. And people walk away thinking they actually own some, when they don't. And that's not just misleading, that's sinister. Remember at the beginning of this video I said there will only ever be 21 million Bitcoin. And that's still true. But what we've uncovered is that the number of claims floating around can make it feel like there are 50, 60, or maybe even 100 million Bitcoin in circulation. And that disconnect between real supply and synthetic claims is one of the biggest hidden risks in the entire system. If you're holding real Bitcoin, on-chain, self-custodied, cold storage, then you're on solid ground. But if you're holding an IOU, a fund, or a promise, just know what you're holding, because not everyone's going to get the redemption they're hoping for when the tide finally rolls out. That's it for this edition of the Bitcoin Effect. If you found this episode helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss the next one. We'll see you next time.